What would be the big takeaway from the big, beautiful bill for Asian markets? Because that could be yet another sort of a driver for the U.S. side in terms of liquidity flowing. Is that a good thing for Asia?
Well, I guess in the immediate term, definitely for markets, the One Big Beautiful Bill is definitely positive for markets given the aggressive rate cuts, the aggressive tax cuts that's in place, and also the fiscal spendings that are in place for the overall markets. This is definitely going to lift the annual spirits a little bit more. But on the other hand, I guess there'll be also risks to the overall debt situation for the U.S. Looking at the overall debt situation right now, the U.S. debt currently has about 37 trillion of debt in the U.S., and that is going to raise debt further in the next decade by over 3 trillion, and this is going to definitely worsen the overall fiscal situation. The overall, the yields will also rise over the longer term.
Yeah, thank you very much. This is really the question that I've been asking all this morning to all our markets guests, that this adds more spending, this worsens the U.S. fiscal deficit profile. So does that mean that it will be further accelerating the whole de-dollarization theme that we spent a lot of time talking about just so far this year?
Yes, I think the overall de-dollarization theme will continue further for the rest of the year. Already, we have seen the dollar index dropping by some 12% from the peak. Right now, dollar index as it stands at about 97, so it has fallen about 12%. And going forward for the rest of the year, we continue to see certain depreciation for the dollar against all other currencies in the region. And I suppose, given that investors are also looking at the continued fiscal situation in the U.S. that's going to worsen, and that will continue to put further pressure on the dollar.
So, Jeremy, big beautiful bill, that's through. So I guess, there is fiscal stimulus to look forward to, even if yields do go up, and maybe that's a problem for another day, right? On trade, though, the U.S. just signing that deal with Vietnam, so that's, I guess, a win for Trump. There was yet another framework with China, but the going seems to be pretty slow. How confident are you that there are going to be a significant number of deals, enough deals rather, to I guess, help market optimism before July the 9th? Or do you think that deadline is going to get pushed back again?
Sure, I guess the 9th of July deadline could be further extended, given that what we have seen, there's probably only 3 deals in the, out that we have seen details. Yeah. And the details are really on the surface. They are really not, they are really framework kind of details, and really not how really the nuances of the deals in place. So going forward, I guess in the coming week to go, we could potentially see more deals that will be forged, perhaps more details on the China front, and all the other markets within the region, especially India, or even Japan, for that matter. But what we have seen last night is that obviously for the I would say the deals that have already taken place, is that they have been quite positive for the markets, given that looking at the UK deal that was being forged, the Vietnam deal that was actually being forged, they are actually quite positive, meaning to say that we could see potential more favorable deals that is better than expected by the market, and that could perhaps lift markets further in the second half.
Yeah, how much help are you expecting from the Fed? Because let's pick up a wall of our own big, beautiful wall showing the jobs report, which dropped overnight. Headline, a lot stronger than expected. I think that's fair to say. 147K unemployment slipped for one. And we saw the impact on yields. They edged up, right? But when you dig a little bit deeper and look under the hood, right, most of the jobs growth was from government jobs, not from private sector jobs, which is A, worrying, and B, I think has a lot of people thinking, look, this points to, is yet further evidence of slowing job market momentum in the U.S. So what is the Fed going to do you think?
Well, I guess the Fed, looking at the bill that is being passed, that's being signed by the House of Representatives last night, I think that will put the Fed, more reserved in terms of the rate cut cycle. Given the we can look at the Fed probability of rate cuts in July that has actually sank from 20% to almost near zero.
Almost priced out, right?
Yeah, it's almost priced out. Yeah. So what we are seeing is that the Fed perhaps could see more, the inflation could be picking up in the second half because of the big beautiful bill, and also looking at the yields that are also climbing. I think the Fed they still want to actually preserve some policy ammunition, so to see whether the inflation situation worsens in the coming future.
How challenging is higher inflation, also higher yields, going to be for equities, U.S. equities?
Well, definitely it's going to be a pressure for U.S. equities, given that inflation is going to pick up in the second half. We see that all these bills that are going to be passed, that will have a secondary impact on inflation that's coming forward for U.S. markets. And for U.S. companies, they will have to pass on this cost to U.S. consumers. And given the fact that, like you mentioned, even though last night the job reports have been quite positive, 147,000 in terms of the non-farm payroll numbers. But on the other hand, you have seen private payroll numbers the day before that has been a negative read. So I think there is a lot to read through to this, is that the health of the economy in the second half could look slightly worse than in the first half.